What if the biggest fortunes in the world weren't built on flashy technology, or viral startups, or the next big trend, but on businesses so boring, most people never even notice them? Imagine two investors. One chases exciting companies, electric cars, artificial intelligence, space tourism. The other quietly buys shares in a company that makes industrial screws, or rents portable toilets, or manufactures cleaning chemicals. Guess who becomes wealthier over the next 20 years? History gives us an uncomfortable answer. Again and again and again. Because while everyone else is looking for excitement, smart investors are looking for something else: predictability, cash flow, pricing power. Businesses that quietly print money while the world isn't paying attention. In fact, some of the greatest investors in history have made billions buying companies that most people would never brag about owning. So why do boring businesses create extraordinary wealth? And why do the richest investors keep buying them, even when everyone else is chasing the next shiny object? To understand that, we need to go much deeper. Level 1. The excitement trap. Humans love exciting stories. Our brains are wired for novelty. A startup promising to revolutionize transportation sounds exciting. A company making cardboard boxes, not so much. The stock market reflects this psychology. Exciting companies often attract massive attention. Investors rush in. Prices climb. Expectations become unrealistic. Sometimes, the story becomes more valuable than the actual business. We've seen it repeatedly. The dot-com bubble, the SPAC craze, cryptomanias, meme stocks. Every generation believes it has found a shortcut to riches. Most eventually discover they were paying too much for hope. Meanwhile, the companies nobody talks about keep operating. Factories still need packaging. Hospitals still need gloves. Restaurants still need cleaning supplies. Construction sites still need concrete. People continue buying toothpaste, toilet paper, soap, trash collection, water. These industries rarely appear on magazine covers, yet they never disappear. This is where smart investors begin thinking differently. Instead of asking, "What's exciting?" they ask, "What will people still need 20 years from now?" It's a subtle difference, but it changes everything. Level 2. The hidden power of predictable cash flow. Imagine owning two businesses. The first sells virtual reality headsets. Sales explode one year, collapse the next. Nobody knows what demand will look like. The second provides waste management services. Every week, garbage needs collecting. Every month, customers pay their bills, and year after year, the cash keeps coming. Which business would you rather own? Most investors underestimate one simple truth. Businesses don't become valuable because they're exciting. They become valuable because they consistently generate cash. Cash flow is the oxygen of every company. Without it, growth eventually stops. With it, a company can survive recessions, acquire competitors, pay dividends, reduce debt, buy back shares, expand into new markets. This is exactly why legendary investor Warren Buffett often emphasizes businesses with understandable economics and durable earnings. He isn't searching for excitement. He's searching for certainty. One famous example is insurance. Insurance sounds incredibly boring. People buy policies hoping they never use them. Yet insurance companies collect billions in premiums long before paying claims. That creates something called float. Properly managed, that float becomes investment capital. It helped transform Berkshire Hathaway into one of history's greatest wealth-building machines. The business wasn't glamorous. The economics were. Level 3. Boring businesses usually face less competition. Here's something fascinating. The more glamorous an industry becomes, the more competitors rush in. Think about artificial intelligence today. Thousands of startups, billions in venture capital, relentless competition. Now compare that to companies making industrial valves, or warehouse shelving, or asphalt. Not many entrepreneurs dream about dominating the asphalt industry. That's exactly why existing businesses often enjoy enormous advantages. Less competition means higher margins, more stable customers, longer relationships, and sometimes near monopoly positions within local markets. Take waste collection. Once trucks, routes, landfills, permits, and contracts are established, competing becomes extremely difficult. A new company can't simply appear overnight. The infrastructure is expensive. The regulations are complex. Customers rarely switch providers. This creates what investors call a moat. Not the medieval kind. A business moat. An advantage that protects profits from competitors. The wider the moat, the more durable the business. Some of the strongest moats aren't built with futuristic technology. They're built with logistics, distribution networks, government permits, customer habits, brand trust, and scale. The result? Years of reliable profits without constantly fighting for survival. Level 4. The billion-dollar businesses hidden in plain sight. Let's look at companies many people overlook. Cintas supplies uniforms, safety products, restroom services, and workplace essentials. Uniform rental doesn't sound revolutionary, yet millions of workers wear those uniforms every day. Customers sign long-term contracts. Replacing providers is inconvenient. Revenue becomes remarkably predictable. Then there's waste management. It literally collects trash. Hardly anyone dreams about becoming a garbage billionaire, yet garbage never stops. Cities grow, businesses expand. People generate waste every single day. The company owns valuable landfill assets that are incredibly difficult to replicate. That creates powerful pricing power. Another example is Sherwin-Williams. Paint isn't exciting, but every new building eventually needs painting. Old buildings need repainting. Homes require maintenance. Professional contractors often stick with brands they trust. Consistency matters. These businesses quietly generate billions, not because they're trendy, because they're essential. The same principle applies across industries. Industrial gases, packaging, building materials, water infrastructure, laboratory equipment, commercial cleaning, payroll processing, business software for accounting. None dominate social media conversations, yet collectively, they generate extraordinary wealth. The public notices products. Investors notice systems. And systems usually make more money. Level 5. The psychology that separates great investors. Here's the biggest lesson. Most people invest emotionally. Great investors invest rationally. When headlines scream about the next revolutionary technology, people fear missing out. They buy high. When boring companies quietly produce another year of steady earnings, nobody pays attention. Ironically, that's often where opportunities appear. This mindset requires patience, because boring businesses rarely double overnight. Instead, they compound year after year, decade after decade. Compounding is deceptively powerful. Imagine a business earning consistent profits. Management reinvests those profits. The business grows slightly. Profits increase. More cash gets reinvested. The cycle repeats. Eventually, small annual improvements become enormous wealth. This is why long-term investors often outperform traders. They're not constantly searching for the next winner. They're allowing excellent businesses to do what excellent businesses naturally do. Produce cash, reinvest, grow, repeat. Even during economic downturns, many boring businesses remain surprisingly resilient. People postpone buying luxury goods, but they still need electricity, water, healthcare supplies, packaging, food distribution, maintenance, cleaning. Essential services become the backbone of an economy, and the backbone usually survives storms better than the fireworks. This doesn't mean every boring company is automatically a good investment. Some are poorly managed. Some carry too much debt. Some face technological disruption. Smart investors still analyze financial statements, competitive advantages, management quality, capital allocation, profit margins, and long-term demand. The lesson isn't to buy anything boring. The lesson is to stop confusing excitement with quality, because the market often rewards discipline. More than entertainment. Conclusion. Every investment tells a story. Some promise to change the world. Others quietly keep the world running. History suggests that the second group deserves far more attention than it gets. The businesses that manufacture the invisible parts. Move the freight, process the payroll, collect the waste, supply the factories, maintain the infrastructure, deliver the essentials. They rarely become headlines, but they often become fortunes. That's why some of the world's smartest investors continue buying companies most people ignore. They understand something the average investor doesn't. Wealth isn't built by chasing excitement. It's built by owning businesses that solve real problems, generate reliable cash, and keep doing it year after year. Because in investing, the loudest opportunities are rarely the most profitable. The quiet ones often are. So the next time a flashy new trend dominates the headlines, ask yourself one question. What boring business is quietly making money while everyone else is looking the other way? The answer? might just change the way you invest forever.